So again, similar to what Josh mentioned before, our bullish pre-runners, our bearish pre-runners, we're talking about a bullish runner. So the bullish runner is you're looking for the stock price to go up after the earnings announcement. So institutions expect some stocks to have a large price increase after a positive earnings report, and leading to major buying pressure right after the announcement will push the price higher. So I found too that in the past, even if the stock reports lackluster earnings or even sometimes negative earnings, if the market as a whole is moving higher, you might see some of these bullish runners still move higher, even if the actual announcement is a little lackluster or not as good as expected. The stock still could easily go up. And that's the beauty about testing on the platform, because you can kind of put some data behind that. So typically your bullish runner is going to, again, on historical analysis, we're looking for the price to typically increase from 1 to 20 days after the earnings announcement. So similar to what was spoke about before, it's very imperative that if a bullish runner shows the most optimal exit day is 10 trading days after the earnings announcement, that's the most optimized one that we have within the system. So I would use that, because some of those days after, if you go 20 days out, like Sudhir I think mentioned before, that could substantially change the profit factor that you're going to see on the trade. So when you run some back tests on your own, you can see those clearly in the data when you're kind of running that analysis. So the bullish runner strategy is trying to capture at least 25% profit on the long call within that 20-day window. And again, just like the other strategies, if you feel that 25% isn't optimal for your portfolio, you can test it out higher or lower and see what the results are. And if the results seem positive, then again, you can put that trading plan in place and run that in your platform and in your account. Again, the trade on the bullish runners, it's going to be closed if the profit target is met, the stop loss is met, or the time stop, which could be, again, 1 to 20 days after the earnings release. The long call is going to be the best strategy for the bullish runner. We're talking about a short time window. You're talking about 20 days, 20 trading days out. So really, the best bang for your buck is going to be a long call. You could trade a strategy like a bull put or like a bull call spread, but when you're trading spreads such as that in such a short trading window, if the stock does go up, your long call is going to gain value, but your short call is going to gain value as well. So it doesn't run up or gain as much profit over that particular time frame. So it's a little more difficult to kind of manage out some of those trades. Let's see, and again, multiple option links typically aren't optimal, just what I exactly said. So credit strategies like naked puts, are strategies that you could analyze further for a strategy like this. So basically, if you expect the stock price to go up, you could sell some puts and collect that premium and get out of those if the stock does go up or when that time frame has hit. Again, like the long straddles and the long strangles before, it just takes up a decent amount of margin or buying power when you do that. But those are good trades that you can kind of look at if that's a trade strategy that matches your investment risk in your portfolio. So this trading strategy, long call, similar to what was talked about earlier. We're looking to enter in the day after earnings, 1 day after earnings, and then exit 20 days after. But if the back test has shown that we exit 10 days after, this 20 would change to 10 for that one to be most optimal. 25% profit on the initial cost of the trade. We used 100% stop loss on these trades. But again, as a personal preference, if you wanted to change that, you could do so. 60 days to expire for your options. We're using monthly options with a 30 delta. 60 days, I feel, is pretty optimal for these because you are getting in and getting out fairly quickly. So within 20 days, you shouldn't see too much, time decay over if you have 40 days left on your option after getting out. It's possible, but you shouldn't see it that much as you would if you sold like an option, or if you bought an option that had maybe 30 days to expiration, you'd be cutting it pretty close there. How to find good candidates. This one, we use that screener like we showed before. We're looking at the closing price 20 days after, has to be greater than 3%, 7 out of the 10 earnings. So basically you're looking for a stock that has moved at least 3% over the next 20 days after the earnings announcement, and it's happened 7 out of the 10 past earnings. If you look at AMD here, we can see AMD, the earnings here, it kind of went sideways and then shot up. On this earnings announcement, it went down and fairly sideways. Here we had a big spike up, and here the same. It dropped down and then had a gap up and started moving higher. So you can kind of see the bullish runner. A good mix, I think, of some of these here, because typically a lot of these bullish runners, you'll see a decent run up, not as elevated as that, but a gradual run up. So this is pretty good because it's showing you a fairly good mix. But you can see we still made money on some of these, on all of these trades actually. But you can see this one in April, you made a slight profit, 20 bucks, not that much as compared, but still a pretty good, pretty good trade. And some of these other is substantially better. This one was almost double the money. So if you do get a gap up and you have an order working to get out at 25%, typically they're going to fill you better than 25%, but it's not always a guarantee. So that's, that's always a possibility. 100% win rate on AMD using the Bullish Runner strategy, 1086 profit factor, and you can see the profit over time. The most optimal time frame for AMD in this Bullish Runner trade, when Josh did the back testing and kind of ran all the numbers, was to enter the long position after the earnings announcement, and then you're going to exit 16 trading days after. So this is kind of a scenario from the virtual portfolio that I added to the actual PowerPoint here for you guys. You can see that if we go back in time real quick, I'm going to go back a couple days. So you can see this trade signal came out on 10/28, was to buy that option, and then getting out on 11/5. So if I'm looking at the virtual portfolio here, I took my calendar back to 10/28 and I was entering in the trade just like I would based on the recommendation from the platform or that earnings plan. So you can see I got into AMD. I used the January 15th option, which gave me the at least 60 days to expiration. I used the 87.50 call because that had the delta just above 30. And then the option, the mid price was around 363 at the time that I put that into the virtual portfolio. If I entered it into the virtual portfolio on that day, you can see the layout of the virtual portfolio and what it would look like within the platform. So it shows you the long call, my entry date, AMD, I buy to open the 87.50 call, January expiration date. I just bought one, and it gives you your prices and things. It also shows you, essentially like your risk percentage, your return on profit, some other different factors that you might want to look at as well. But the virtual portfolio too, it has a lot of information in there, and it's a great tool to use, so you can kind of explore that a little bit later. But now if I go forward in time in the virtual portfolio to 11/5, which was the trade exit as noted on that previous slide, we can see the same long call, 87.50 for AMD. It cost 363, but now the current value is 520 bucks. So my profit was 157. We can also look at this, my return on profit percentage, 43%. So I made a 43% profit on that, or 43.25 profit on that particular trade. But I just wanted to kind of show you moving forward in time, you can do that analysis on your own within the platform, whether it be these earnings trades or other trades. Here's a risk or an equity graph, for the trade. So basically taking that information on the previous slide within the virtual portfolio, you can see over time from when I got into the trade here throughout the life of the trade, this is what my portfolio or the position would look like. Slight profit here, it went negative, and then back to profitable after that. I thought I showed more on that, so I apologize. It might be on a different slide where I actually show the breakdown. So that's what your graph would look like from the platform as well. Intuit is the next trade that I'm looking at. You can see a similar fashion here for the Bullish Runner. On this trade here, earnings announcement, stock dropped down, but it did have that spike up. So we might possibly able to recoup a little bit based on that little spike up. Earnings here, somewhat sideways. Earnings here, spike up a little bit. Earnings here, sell off, and then a spike up. So you kind of see the life of those particular trades. Here you can see on the 5/22, we actually took a little bit of a loss, which was in May. So if I go back, we're talking about this trade here where it actually sold off and kind of just went sideways. We actually lost money on that trade. It looks like we made a little money on the February trade. So if I go back, sorry, February, you can see we made a little money on that option because it did sell off, but it did have that spike up, but it took a little time, February 25th to March 5th. So. What I wanted to show you though is this is the actual back test within the platform, and this is where possibly we'd look at the daily P&L. But we can see, so for the Intuit trade, what I did was I went into the platform and I ran an earnings back test for Intuit using the Bullish Runner strategy. And this is what your results would look like if you were actually going to in the platform and run an actual back test. I used it as a Bullish Runner. You can see this particular trade displays that on 11/20, we would get into the trade where, so on 11/20, we would buy to open one April 16th, 390 call for 11:30. And then on 12/3, we would actually sell it for a profit and we would sell it for 16.15. But what you can see here is you can actually see the underlying price of the stock was 347 when we entered the trade and 363 when we actually exited the long call position. You can also see your implied volatility here as well for the options at the time of entry and of exit. This is pretty crucial on some of those trades like the vol crush trades, because you can see when you enter a vol crush trade, you might see the implied volatility over 100. And then after, when you exit, you might see the implied volatility at 20. So there's a lot of good information that you can see, or a lot of data that's available to you when you do run a back test in the platform as well. This is your daily P&L. So basically on this trade here, it opened on 11/20. I got out on 12/3 for the profit. So you can see here, trade date 11/20 all the way down to 12/3. We can see a daily summation of the option as we go in time. You can see the option, my running profit, or in this case, my loss. And you can see where the underlying price of the stock was in relation to the value of the options at that time as well. So entered the trade 347, 343, 345. So the stock price is going down. And obviously you would assume that I'm losing money on the option, which I am here. And then as the stock price starts going up all the way to 363, you can see I'm gaining value on the option as it's going up as well. And then here's another chart within the back test also, which is, I find a pretty great feature to do some analysis also, is you can see that, so my line here where this green bar starts is the actual start of the trade. So that would be on trade date 11/20 is right here. And then this is going to be the life of the actual trade. And then my trade exit would be this last day here. So you can see another equity graph or profit and loss graph here. And then, but you can see some analysis with the stock movement there and how that stock price is moving over the life of that particular trade. The most optimal time frame for the Intuit Bullish Runner trade is to enter the position the day after the earnings and get out 19 trading days later. Again, get out 19 trading days if you're still holding it. 20 days, that the results could be quite a bit different based on that past analysis. So always look at that. For these trades here, we're looking at 43 potential trades in the Q4 plan, have an 80% to 89% win rate. And then there's 33 trades, potential trades with win percentages above 90%. So you can see that similar to that bullish pre-runner, this is probably a more popular one just based on the sample size that you have. And obviously the stock market being the way it has been in the past with it moving higher. But you do have a pretty decent sample size with this strategy. Like Josh mentioned earlier, trade entry, don't forget to skip the holidays in your trading day count. Enter the day after the earnings announcement, and again, always use those limit orders. You're going to exit the trade 25% profit, and with these, once I get filled on my entry, I always put my 25% profit in my account, and I just go ahead and put it in GTC. Similar to what Samir had noted before, if it's to exit the trade 19 days, I make sure I'm count 19 days out on my calendar. I put a note there so I get an alert. And I just say, all right, today's the day to exit if I still have the Intuit position in my account, if it's 19 days past and I haven't hit that profit yet. Again, you're going to exit the trade 20 days or what the test shows is the most optimal. And remember, AMD was 16 trading days, whereas Intuit was 19. So you're always going to want to pay attention to that. that's the end of that bullish runner strategy. So do we have any questions on that one? I don't know if we have any questions, Josh, or not. I didn't see any.
Nothing coming.
I had a couple of things that I wanted to mention, but I completely forgot, so I apologize. Hopefully I remember it as we go through, but these slides pretty much cover the majority of it. Let me try to think for 1 second what I was going to say. All right, I can't think of it, so I'll move on, and if it comes to me, but please feel free to ask some questions. I know, or I think I know, I'm not this good at explaining it, so I hope some people have some questions for me.